Let us get started here, shall we? Okay, so what happens to your US retirement accounts when you move to Australia? This is a very broad topic, so you're going to see that tonight's presentation is focused specifically on IRAs and 401ks. I apologize to those that were looking to find out about Roths. I have a hint as to how they're treated, and it's not good, unfortunately, but we won't be getting into that tonight. All right, so a little bit about me. I'm a tri-citizen of the US, Australia, and the UK, born in the UK, raised in Australia, Brisbane, Australia, and have lived in the United States since 2005. I've been a financial advisor since 2010. I'm a CFP. I did level 1 of the CFA, and I'm on the International Knowledge Circle for the Financial Planning Association. Arete Wealth Group, who are we? What are we all about? Essentially, we're a fee-only, cloud-based, virtual and in-person firm specializing in the needs of Australian expats in the United States and American expats in Australia. Then, of course, there's our... that's I got ahead of myself right there. And Arete Wealth Strategists is focused on the needs of domestic business owners and executives. So, of course, those Aussie expats that happen to be business owners or executives really fall into our sweet spot. This gives you a sense of all the different topics that we provide assistance with or referrals to. And I came up with this, or I should say, our graphic designer came up with this, this diagram here to describe the types of Aussie expats that we work with and the differences in their needs. So essentially, we have really who we're focused on working with, and that's the established Aussies, those that have decided to make the United States home or are here for a very extended period of time, measurable in decades. Secondly, there are the longest stays, the folks that I would call domicile uncertain. They don't know if they're going to be here for the extended future or not. They'll come to see what happens. And then, of course, there's the short stayers, the working holiday people, that know that they're returning to Australia, and they have very specific advice needs also. All right, service tiers that we offer, really we offer 3 different kinds of service models to Aussie expats. Situational advice, where we provide a statement of advice for a specific question. Here is what you should do given the question that you pose. Alternatively is comprehensive financial advice, so looking at your overall financial situation, doing a budget analysis, liability analysis, risk management, retirement analysis, and seeing how one's financial trajectory looks over the longer term. And our top tier service is what we call Wealth Fusion. That's the combination of financial planning and investment management together. And we waive the separate comprehensive financial planning fee for clients for whom we manage more than $350,000 of assets under management. Announcements. Well, I'm very excited actually. Tomorrow I'm headed off back to Australia. It's going to be my 20th high school reunion, so off back to Brisbane. I'll also be visiting clients and prospective clients while I'm there. And I'm very pleased to say that the new website is up also. So you can see here, I'll be referring to this a little later on. You can see our key financial data sheet if you click here under media, so you can bring that up. So I'll refer to that again. Okay, back to present. All right, outline of tonight's presentation. So let's start off talking about the different types of US retirement accounts. There are a whole variety of them. We'll look at their tax treatment in the United States while you're still present in the United States during the accumulation phase, what the contribution limits are to those US retirement plans in order to help you make intelligent contributions while you're here. When providing advice on when you can get your money out of a US retirement plan, what required minimum distributions, how to make contributions back to your superannuation account. How does Australia and the ATO treat the returning funds from the United States? And then how do we think about global investment allocation? Okay, so US retirement plans, they can be broadly broken down into 3 different varieties as we see here. So defined contribution, defined benefit, and deferred compensation. And they each have their own quirks worthy of a brief description here. 401ks, they are company-specific plans. This differs fundamentally from Australia, where superannuation is enshrined in law and essentially everyone is following the exact same plan. 401ks, they can be company-specific and differ across a range of factors such as profit sharing, employer match, vesting schedules, particular eligibility for loans, what the retirement date definition is, as we'll see shortly. 403bs, pretty much exactly the same as 401ks, except for that's the non-profit teaching and government sectors of the economy. Traditional IRAs, that's an individual retirement arrangement. Of course, we all default to saying account, but it's actually technically arrangement. Much lower contribution limits, and that's independent of a company. So absolutely everyone has that available. That is baked into the tax code. And then of course there's the Roth type of account, which is still a defined contribution account, but the tax treatment is completely mirror opposite to what you see with the so-called traditional plans. Defined benefit, what are they all about? Defined benefit, sadly, they are the retirement plan of yesteryear. Don't need to be for individuals in the right kind of situation. But that's where someone receives a specific retirement income stream typically for the remainder of their lives and possibly for their spouses as well. Deferred, and they come in a variety of types, as you see there. Deferred compensation it feels so similar to a defined contribution account, but it's fundamentally different in that the defined contribution account is your money, excluding unvested profit sharing contributions. If you have made your $18,500 employee deferral to your 401k, that is your money. If your employer goes under, they can't touch it because it's not their money. Deferred compensation, on the other hand, is subject to recognition of income. So what that means is once a condition has been satisfied that you have received that income, then you can be taxed upon. That money is then taxable. Until that point in time, however, it's not taxable, so it can grow like a 401k, but it is still subject to the company's creditors. So it's a little bit less attractive than having a 401k. Okay, really, as you heard me say at the outset of tonight's presentation, for those that hadn't joined at that moment, we're going to be focusing on 401ks and traditional IRAs because that's where 90-something% of all the inquiries that I get and that I see out there are to do with. Let's move on to the next topic here. So the US retirement plans, contribution types, and accumulation phase tax treatment. That is a mouthful. Okay, so the tax deductible type of plans really are your 401ks, your 403bs, your traditional IRAs. Your defined benefit plans, you're not, as an employee, you're not really making a contribution to that account. That's being done by your employer, and that's partly the reason why they're going out of fashion, is because employers are wanting to get that particular funding obligation off their shoulders and onto the employees, which only magnifies the importance of long-term financial planning to make sure that you have taken responsibility for you and that you have sufficient resources to get you through your retirement years. Now, the totally different type of retirement plan from a tax perspective is, of course, the Roth type. So Roth IRAs, Roth 401ks. Roth 401ks, maybe not a lot of people will have heard about Roth 401ks. Essentially, it is something that can be bolted onto an existing 401k plan. It's not a different type of 401k plan, like, oh, I'm sorry, my employer only offers a traditional 401k. That may be the case that they only offer a traditional 401k, but there aren't companies out there that either have a traditional or a 401k. You have a traditional, or you have both. You add the Roth option. I think it's overhyped because it violates, in my opinion, in the majority of instances that I see, where I'm dealing with accumulation phase, higher income earning individuals that are making good money. To be contributing to a Roth at that point is really going to upset your lifetime tax payment. The amount of tax you're paying over the course of your life. Why on earth would you make after-tax contributions in your peak income earning years when you should be doing that in your lower income earning years if you take a sabbatical, if there's an unemployment situation, or a part-year employment, something like that? That would be the time to make a Roth contribution. So Roth 401ks don't see a whole lot of action with those. But Roth IRAs certainly have their place. And for clients, I get into talking about the concept of tax asset classes. Different type, the way the Internal Revenue Code is written makes us think that there are different types of tax asset classes. There's ordinary income, there's long-term capital gains, there's these tax-deferred buckets, as we see here on the left, the 401ks, 403bs, traditional IRAs. And of course, there's tax advantage, which includes a range of different types of assets, but Roths would certainly be amongst them. HSAs, health savings accounts, muni bonds, and cash value life insurance, but again, very specific and has to suit the right kind of client. Okay, so lastly, there's the employer contribution, which is received tax-free. Thank you very much to your employer if they're giving you a profit share or a generous match. That's going to grow tax-free. And of course, coming to the next slide, coming to the next slide, we'll see how that's taxed in a moment. But right here, you will recall a moment ago in the announcement about the new website that's up, you can come and download the key financial data sheet. I do intend on producing an Aussie expat version of this to include the Australian current financial year tax brackets and superannuation contribution limits, a range of other key financial metrics that Aussie expats and US expats to Australia would be interested in knowing about. But we haven't done that yet. Okay, getting ahead of myself here. So how are these retirement plans taxed in the US upon distribution? This is how they're taxed. Really, it's very simple. If it's a 401k, 403b, traditional IRA, or a defined benefit plan of any variety, it's taxed as ordinary income. Simple as that. So what the government giveth during the accumulation years, the government taketh away in retirement. So being aware of this asymmetric tax treatment of how the retirement system works here in the United States, we should be mindful to maximize our tax deductible contributions during our peak income earning years, and consider making strategic Roth IRA contributions in the early retirement years. However, I will state that really applies only to those that will continue to stay in the United States for shortcomings that exist with Roth IRAs, for returning Aussie expats, that is. For US tax residents, Roths come out tax-free. So you've paid it with after-tax money, ideally at a much lower tax bracket, such as what we see here in a 10, 12, or even 22% bracket as the rates are currently written, and then be taking that out in retirement. Maybe you need a lot more money than that to live on, and so you can draw from this different tax asset class and keep your effective tax rate lower as a result of having a tax-free source to draw from. Okay, contributions and limits. How much can you actually put away to a 401k? It is remarkable the number of people that aren't aware of this, and there's no shame in not knowing it, because I feel that the United States doesn't do a very good job at communicating this information in the first place. Most people believe that they can contribute only $18,500 in the current 2018 tax year to their 401k. Wrong. No, that's not true. Yes, that's the employee contribution, as we see here at the top, the tax-deductible employee contribution. That's right, but in fact, you're limited to $55,000, and the term the IRS uses is allocation. $55,000 may be allocated to you. Now, that comes in a variety of different ways, and in the last couple of years, there's been a very pleasant change for U.S. tax residents. Emphasis, U.S. tax residents, not returning Aussie expats. Okay, so you can put away $55,000. That $55,000 amount is comprised of the following 4 buckets. So there's your 18.5 tax-deductible employee contribution. There's your employer match, if your company offers one. There's an employer profit share, again, if they offer one. It's totally discretionary and dependent on the employer. And then recently, in 2015, there was a welcome change made for U.S. tax residents. Yet again, I underline U.S. tax residents, where you're able to make what's called a post-tax non-Roth contribution. Well, what's that? That's essentially making or taking advantage of the remainder, the unused component of that $55,000 contribution, making an after-tax contribution there. So yeah, it's done with after-tax, not as good as tax-deductible, but the IRS gave relief, and it will allow you, according to your 401k plan document. Again, 401ks differ from one employer to the next, and each and every client I take on, I'll look at the summary plan description of their 401k and see what it will see if it allows post-tax non-Roth, and what the rollover rules are for how we can get that into a Roth. Because if we can get into a Roth, that's fantastic. That gives us extra headroom to get money into a tax-advantaged account. However, as I said, depends on the plan. All right, so $55,000. If you happen to be over age 50, you can contribute an additional $6,000 of tax-deductible contribution. Traditional IRA, this is going to be a lot quicker. Simple as $5,500 tax-deductible. If you're over 50, you can do another $1,000. Of course, why this presentation is structured the way it is because many people will have taken advantage of the flexibility that exists to move from your company 401k out, I should add, the restricted set of investment choices in the company 401k out into the big wide world of being able to invest in practically any stock or bond within what's offered to IRAs. However, you have to be lower than age 70, less than age 70, to open an IRA. How can you get your money out? Well, here's the answer. How can you get when can you get your money out? Really, it's age 59 and a half. And before age 59 and a half, a 10% penalty tax applies. So what have we learned so far? How does the US treat distributions from your retirement account? A, it's subject to ordinary income tax, which is, as you heard me reference before, go look at the key financial data sheet to see exactly what they are for you, because there's tax filing statuses that you need to be mindful of, and then there's the progressive tax scheme that applies. So there's ordinary income tax that's applicable. Take it before age 59 and a half, and bam, you have to pay an additional 10% penalty tax on that. Now, I say 59 and a half, but as you heard me say so many times already, depends on the plan. Most plans are written at age 59 and a half. However, you can see some plans written at age 55, and even some government plans written at age 50. Loans may be available from 401ks up to as much as $50,000. It's the lesser of $50,000, or sorry, 50% of the account balance, or $50,000. Traditional IRA, really the same deal as you heard above. 10% penalty tax if you take a distribution prior to age 59 and a half. However, you can take up to $10,000 for a first-time purchase, or the penalty tax. Please don't get confused here. Ordinary income tax is always owed on these distributions. The only exception here is the penalty. The 10% penalty is waived in the instance of the first-time home buyer, the higher education cost, or hardship withdrawals, and there's a bunch of those, but they mean it when they say hardship. So not things that I see very often, nor would you want to have happen. Required minimum distributions. Okay. At age, in the April following the year in which you turn age 70 and a half, to be as specific as possible, you are required, according to this schedule here, to liquidate your retirement account. Now, we're talking really about IRAs and also 401ks, 403bs. So essentially, you take the account balance and divide it by this, this number here, the Uniform Lifetime Distribution number, and that is what you must distribute from that account, and it will be subject to ordinary income tax as it comes out. Okay, so US taxation on the distribution of an IRA. Now this is where I should, maybe it was mistitled, I should have said international considerations on the US taxation of the distribution of an IRA or 401k. So normally a 30% withholding rate applies. So oftentimes clients or prospects that will have called their brokerage firm will have been told, I need to withhold, they tell me I need to withhold 30%. Here is the thing. This is such an obscure and convoluted and complicated area of tax law. I don't for 1 second believe that the rep at Fidelity knows the answer. And here is the answer. In the Australian tax, in the Australian-US tax treaty, it's actually 15%. So we have a better withholding rate. That's not to say that you may owe more tax. You may very well owe more tax. That's just the initial withholding rate. And it may even be possible, due to the complexities of reading the code, and I'm referring specifically to Section 18, Article 18.1, if you go and read that, you'll see there is some ambiguity as to how pensions are treated, but it would be, in my opinion, for an account holder with significant assets, and I mean maybe $500,000 or more in a retirement account, it would be money well spent to hire a tax attorney to perhaps obtain a private letter ruling to make sure you're getting that, what could be tax-free treatment out of that fund. That would be fantastic. And we'll get to what the ATO requires on the other end. So it'd be nice to get tax-free treatment in the US. Does that mean it's going to be tax-free in your pocket in Australia? Not necessarily. Let's move on. Okay, so because when the US put together their retirement plans, they didn't pay any mind to what Australia considered a qualified retirement account. Thus, the ATO doesn't consider, would you believe, does not consider an IRA or 401k to be a qualified foreign superannuation fund. That's because it was not written for that intention or purpose. Which goes back, by the way, I do want to draw attention to this group and this movement to fix the treaty. It's horribly inequitable, as you would have heard in my last presentation. Australian expats returning with particularly permanent residents and dual citizens have a very, very, very unfair treatment on how those superannuation accounts are taxed by the IRS. Okay, anyway, carrying on here. So once the proceeds have been received in Australia, they need to be recontributed back to superannuation. They don't roll over like what you may have done from your company 401k to an IRA, a very clean, neat, and tax-free rollover. When you move from your US retirement account to your Australian retirement account, you're having to recontribute that. What does that mean? That means you need to pay attention to what the contribution rules are for making contribution to superannuation. And they include age tests, work tests, and certain contribution limits. The opportunity that I see in this public-facing presentation I'm giving today would be to take advantage of the non-concessional contribution limit. That's $100,000. You can also utilize what's called the bring forward rules. What are the bring forward rules? That allows you to bring forward up to 2 years of additional non-concessional contribution. So you could contribute as much as $300,000 after you've satisfied US taxes, whatever Australian taxes may be owing, which will probably be nothing, but Once that's all been paid, put it into super, and it's very much, you've heard me say this before, last webinar that I did, non-concessionals are very much like Roth. So they go in after tax, but then grow tax-free and come out tax-free. Okay, that's all well and good if you're under age 65. If you're between age 65 and 75, you need to satisfy the work test. This is important. Now, if there is a part to this presentation that's about actual advice that's truly actionable and could save you money, regardless of your situation as discussed so far, it would be right here. Most people, I had an inquiry just on the weekend with this very same mindset of someone. They said, I'm done with the US, I want to move out, I'll relinquish my citizenship, I'll be completely done with the place, and I'm going to distribute all my retirement accounts in a lump sum. Well, you could do that, but such a hasty response could be very costly. And the reason why is it's like the lottery conundrum. This is different. If you're coming at lottery conundrum kind of means something very specific to people that understand how the US tax system works. You win the lottery in Australia, it's tax-free. You win it in the US, oh no, it's not tax-free. That's all ordinary income, thank you very much. The lottery will give you some choice as to how you wish to take those winnings. Do you take a lump sum and get hosed by so much of that money being in the highest marginal tax brackets there are? Or do you take a much lower annual distribution amount and your effective tax rate, your average tax rate, if you will, is going to be much lower because less of that distribution is exposed to the higher tax brackets. And we'll get to that in just a moment. Okay, other timing considerations, foreign exchange. I did want to bring up, thought you might all find this quite interesting. You should be able to see, this is the Australian US dollar foreign exchange rate over the last 3 years, or almost 3 years. You can see we've been in a band between really 70, what are we at there? 74 and 73, or 70 even, over that period of time. So if we zoom out over even longer periods of time, if you're thinking of a 30-year vacation, otherwise known as retirement, you might begin to see why I am referencing the effect of currency, why that could be a significant factor, because it fluctuates. It fluctuates a lot over extended periods. Whoa, sorry, I pressed the wrong button there. All right, getting back to the presentation here. So other timing considerations, foreign exchange, you might want to think about setting up a rule of thumb for how to dollar cost average, if you will, moving your money over so that you're not hit by a particularly unfavorable spot foreign exchange rate at one period of time. Another thing to consider is if you move back to Australia and you were in the United States as a temporary resident, you don't have to file US taxes anymore because what's occurring in your retirement account is not deemed to be a taxable event until such time as you begin to take distributions and or receive Social Security. As you heard me say earlier, US dual citizens, tri-citizens, and other permanent residents that have yet to be surrender their green cards do need to be mindful of their ongoing worldwide tax obligations. Okay, so Social Security, the other thing here is that once you begin receiving Social Security, which can be a very good deal. I was just speaking with a client earlier today who had 7 years of US earnings, who would otherwise qualify for Social Security once she hits 10 years or 40 quarters of qualifying service. She's going to get a pension. And remember, Social Security, unlike Australian age pension, is not means tested. That means Warren Buffett is sitting there collecting his Social Security check every year. That's just how the rules are written. So my point there is that even if you want to move everything back to Australia, or you don't, or whatever the case may be, once Social Security starts, you're going to have to be filing US tax returns anyway. Okay, Australian taxation of IRAs. Now, this is probably 401ks also, but you'll see my little circumflex symbol there. There's no specific case laws to cite that, so we're going to be talking about IRAs specifically. I love making referrals to duly qualified CPAs that know the Australian landscape and the US landscape, as well as tax attorneys, because this is truly their area of expertise. All right, so the way that Australia taxes IRAs, they deem them to be foreign trusts. And the way they look at that is it's essentially the value of the account minus contributions made by the individual and the employer, which really means the growth. What's left after you take out everything that you contributed and your employer contributed? Well, that must have been the growth, right? So something interesting happens. So the Australian Taxation Office is interested in taxing the growth on that IRA, or most likely a 401k as well. However, remember, the US is taxing the entire account balance. So while the marginal rates might be lower in the federal marginal rates might be lower in the US than they are in Australia, because it's taxing a much larger balance and you're accruing a tax credit for that foreign tax paid, it's very likely, although not certain, as you've heard me say, talk to your qualified CPA, it's very likely that the tax paid in the US will give you a foreign tax credit which offsets whatever tax obligation you would be owing in Australia. As you hear me say here, written out. I'll keep that on the screen for a moment longer for anyone that wants to see that. Okay, so nearly done with the presentation here. Global investment allocation. I don't know if I've ever seen a prospective client. This is simply beyond, or maybe I shouldn't say beyond, I just haven't seen it. The tools of a retail investor, not a wealth front, not a retail Morningstar, offers easily the ability to be able to do what I'm about to show you here. But as a globally mobile individual or family as you are, you need to be thinking about what currency you're presently earning your money in and where you intend on retiring to, because that opens you up to a whole range of foreign exchange risks, and as we've seen throughout tonight's presentation, a whole range of other risks related to taxation. So how are your investments allocated? Are you allocating, as most people do, on an account by account basis? So each individual account is, 60% stocks, 40% bonds, as is the traditional moderate account. Or are you taking it a step further than that? You're saying, you know what, I know how my Australian superannuation account is currently invested. So I'm going to invest my US accounts to offset that allocation that they have. That's really thinking as a global investor. And my firm offers the ability to be able to do that. So we have an institutional tool that enables us, as you can see here, identified US currency. We can also identify Australian holdings and then aggregate, report all that up into which either currency you wish to be viewing it on. So that's pretty cool. Feel free to go to the new website, arete-wa.com, under media, and I would greatly appreciate your feedback on tonight's presentation. It's only through feedback that we can get ideas for improvement and how to make this a more valuable resource for folks out there. So thank you very much for attending, and if you're interested in becoming a client of mine, then feel free to go to our contact form and complete that. It only takes 2 minutes, it's very brief. We'll schedule a call and we'll see if we might be a fit for one another. But thank you again for attending, and I'll see you next time.